Good morning once again, friends, respected members, and dear colleagues. After that fulfilling and much needed breakfast break, I hope you are all feeling refreshed, recharged, and ready to dive back into the world of finance and reporting. Friends, now it's time for our second technical session, which promises us to give us a 360-degree perspective on one of the most crucial areas of our profession. To take us this topic, we have with us on exceptional speaker, CA Paresh Clark ji, a name well known in professional circles for his expertise in financial financial reporting, corporate analysis, and regulatory compliance. और फ्रेंड्स, ये सच में है कि इतना अच्छा नाश्ता करने के बाद में हो सकता है कुछ लोगों को नींद भी आ रही हो, तो मैं परेश सर के लिए इतना ही बस कहना चाहूंगा कि नाश्ते के बाद जो नींद आने लगी थी, नाश्ते के बाद जो जब नींद आने लगी थी, अब वो भाग जाएगी। जब क्लास सर की बातें शुरू होगी तो हर बात समझ में आ जाएगी। तो इस वर्ड आई रिक्वेस्ट सी सीमा मेहता to give a brief introduction to our speaker.
Thank you, Kailash, for giving me the opportunity to introduce today's speaker, CA Paresh Clark. He is a regular speaker at JB Nagar CP Study Circle. He has over 2 decades as a partner at Bansi Mehta and Company, specializing in audits and due diligence for both local and international acquisitions, advisory services in accounting and company law matters. He is a chartered accountant with over 40 years of experience. He was a member of the Accounting and Auditing Committee of BCA since 2017, the former member of Corporate Law Affairs Committee of Indian Merchant Chamber. He invited to ICI committee, including Accounting Standard Boards, Council Year 2020-21, India's Implementation Committee, Council Year 2020. He is actively involved with ICI, BCA's Chamber of Tax Consultants. He contributes to publications, writing articles. His article is in Tax Sutra, written article for Tax Sutra also. Regular speaker and participant at various seminars, conferences, and contemporary topics in accounting and profession conferences. He's author of the book Thumb Rules of Bookkeeping, published by BCAS. He was associate professor of accountancy at Mitibai College of Arts, Chauhan Institute of Science, and Amrutben Jeevanlal College of Commerce, Mumbai, from 1986 to 2013. He is a child accountant, as well as he is also cost accountant, and he completed certificate course on IFRS, certificate course on business responsibility and sustainability reporting by ICAI. He is presently director of a listed company, Keval Kiran Clothing Limited. With this brief introduction, I invite our past convener, CA Chintan. Vandan also, you can also join, Mandeep ji, to present a memento on behalf of JB Nagar CP Study Circle.
Children. Good morning, everyone. Because it is before 12 o'clock and you just had your breakfast, I think good morning sounds proper. You know, when Mr. Kailasji called me that we want 360-degree view of annual report. So I was just wondering, am I a right person to address this? Because when you say annual report, that means it is the work of the analyst. I'm an investor, but not an analyst. Be that as it may, then I said, okay, let us look at it. How do we reword the topic and work that way? So those chartered accountants who are in practice, those who are in even industry, how would they look at it? And every chartered accountant, whether he is in industry or in practice, would always be an investor. So at least I am. So you must be more than what I am also investing probably. So based on that, I changed the title of the topic and I said numbers are one thing which you always know. And so we move from numbers to narratives. And once a Revit investor was asked that how come so many annual reports are available and you read them also, but you still pick up the shares which are in a winning spree. How does that happen? So he very simply said that you all read data. I read the story behind the data. And today also, of course, data is a buzzword with AI. And I've used data only and AI only to make my presentation. I'll talk on that a little later. But he went on to say that story will tell you what is actually happening. And that is what the annual report is all about. Right? And you know, we are so much into our rate race and completion of audits and preparation of accounts and things like that. We are not reading annual report. And when I was preparing that, I also realized I am not reading that much what is required. But if you read annual report for even 10 good companies or even 10 bad companies, then you will get the entire gamut of what is happening. You may become a good investor or you may not become a good investor, but you will know what are the story which is being told. a simple example, analysts may look at numbers only. Of course, I'm just not trying to criticize, but sometimes analysts may look at numbers. And you may find that the story says that the company, a pharma company, let's take an example of a pharma company. Pharma company is getting into research, and with which it will, that research, if it's successful, it will turn all the table. Today, their figures are not what it looks like. So this is where we'll all come out with annual report. So that is what my thrust would be on annual report, but at the same time, I was told that your focus should be on listed entities. So many of you may be dealing with listed entities, many of you may be doing audit of listed entities. So may be true that many of you are not doing it. So you may not have idea of Ind AS, but if I have to only talk about Ind AS, it will take 10 sessions. If I have to talk only about one aspect of a report, then also it will take 2 lectures. So what I have tried to do is just taken each segment, each portion, which are very significant for anybody to understand. So the whole presentation would not look very technical, but it will give you an idea that it does work for anybody to know and ultimately to read the financials which are under Ind AS. Because I think the challenge of many chartered accountants are also reading financials which are based on Ind AS. I may be wrong when I'm saying so, but possibly it is true also. So that is where we start. So what I'm trying to talk about is on annual report, its purpose and structure. Yeah. Narratives about financial statements, about audit report, and why I've taken only major 2 topics from an audit report. I'm not talking the whole gamut of audit report, but emphasis of matter, key audit matters. Now, those who are not dealing with listed entities would not have looked at key audit matters at all if you are not reading annual report. I'm assuming that you are not reading annual report. On that basis, I'm going. And emphasis of matter also when you are doing your audits, though it is applicable to any entity, but you may not be using this aspect of emphasis of matter also. So we will look at it, that how these emphasis of matters are dealt with, key audit matters are dealt with. And then, of course, analysis beyond numbers, what all is stored in an annual report. Then, of course, how do whatever frauds are happening, what do you look at it? And then the new thinking, which is an integrated thinking, integrated reporting, that also I will touch upon, because that is a new phenomenon which most of the large companies in India have started using it. And if you read really an annual report or an integrated report, then your whole perception will change. You will automatically become a good investor. And of course, investors' perspective I have dealt with. So now on the annual report, as you know, it is mandated. It is under SEBI LODR, it is mandated. And so, of course, the purpose is it's a vital source of corporate information to shareholders and stakeholders, because it is not that only the investor is looking at it. It is not the auditors is looking at it. Regulators, lenders, everybody would be looking at the entire annual report. So it combines statutory disclosures, financial performance, risk, strategic direction, and governance insights. Because we will deal with what are the components of annual report, and then you will understand that the gamut is so much that you get to know many more things about the company and not only numbers. So includes mandatory components under Companies Act, SEBI LODR, Ind AS, acts as a compliance document an investment tool, and a governance scoreboard. So annual report per se deals with, as I said, all gamut. And I think you must be well aware also, I have taken one slide at the end we will deal with. Even the institute has, have announced or have kept awards for the best annual report, best sustainability report. So all these awards also have been installed in a sense. So those things are also there. And I was just thinking today morning, I said, okay, even if you are reading those awardees companies' annual report, I think you will learn more than what is otherwise required. So it's not much, 10 annual reports, 12 annual reports in a year if you have to read. I think that is also good enough for us to enhance our quality of understanding. So core structure of annual report is corporate information, which I will not deal with. This is basic registered office address and directors, auditors, etc. So this is just as a structure I have mentioned here. But these are the things which are routine in nature. Then you have notice of AGM. Now, even in notice of AGM, at times you may get to know quite a few things. If change in directorship has happened, then which director has changed, whether the director has changed on a regular rotation, or whether the director has changed prematurely. All this also you would come to know, because these are the signals which you should always be looking at, even as an auditor. If some director, many times you say, okay, CFO has left. So your next question will come, why CFO of that company has left? Okay. Was there anything wrong? Recently, only it happened, it was, sorry?
The independent directors resigned.
Yeah, no, so I'm not naming a company or anything, but recently in a company where CEO resigned, okay? I mean, known to us. So the question came is, he had recently joined and then left. Anything wrong? Did he do anything wrong? Or was he not happy with the company? What was it? So all these questions can come in mind, because it's this psychology which we also have to learn. Then financial highlights, because in annual report you have 5 years, 10 years financial highlights which are available, which you ought to study. It could be segment wise available, and that will also give you a very great idea. Then director's report. Director's report, you have, it's of course mandatory, and then you have chairman's message, overview of performance, challenges, outlook, dividend declaration, risk management. Now, this is risk management is another phenomenon which you all have to continuously observe in any financial. We always say risk of material misstatement, but there are other risks also which you will have to look at it when you are looking at any financial or an annual report. Then another thing is management discussion analysis, corporate governance report, BRSR report. So BRSR report is now mandatory for 1,000 listed entities. And it is another area where you can play a very good role. You can enhance your skill set for BRSR sphere. You can, maybe 2 years down the line, 3 years down the line, SEBI makes it mandatory that only statutory auditor should carry out the BRSR report, or maybe say only chartered accountant should carry out BRSR assurance function. So you have the scope for that. Even implementation of BRSR, whether data collection, data pile up, all this is happening appropriately in a company. That area also is a good area which is getting developed. Other statutory disclosures, related party transaction. Now, a related party transaction is so, I mean, most of events or frauds which are happening has somewhere or the other nexus with the related party transactions. You should also observe shareholding pattern. Now, each of these topic which I will deal with in detail at appropriate time during my session. But since we were on annual report, I said before we start, we should know what the annual report which we are talking about. There is a CEO, CFO certification. What is a vigil mechanism which company has? Then consolidated financial statements. So AOC 1 is there, MGT 9 is there. So all these, I think, CEO certification, it is repeated. So additional information, sometimes awards, employee and investor relation, glossary of terms, all these details are also given. And when we look at integrated reporting, I have about 6-7 slides on that also. We will look at it how detailed that integrated reporting could be. All throughout, you know, for preparers as well as auditors, ethics and professional skepticism have to be used when you are preparing an financial statement or when you are preparing an annual report. Your all eyes and ears ought to be open, and your ethics should also there. You have to walk the talk. So here you will have to walk what, I mean, you write what you walk, and you will walk only what you write. So we go to financial statements. Now, as you all know, that financial statement is a core of any annual report. I mean, one thing is very clear that annual report has financial information and non-financial information. If non-financial information are given and financial information are not given, then also it doesn't make a sense. Financial informations are given, but non-financial information are not given, then also it does not hold the water. So you will have to look at this. So provide a structured approach for reading and analyzing financial statement from accounting, auditing, and investor perspective. It deals with compliances. You all in the morning session even understood what compliances could be there for even non-corporate entities. So compliances for corporate entities could be among us. So you will have to deal with compliances when you are dealing with financial statements. Understanding a company's financial health. That is what why we auditors are required. I mean, we are really giving our views whether the accounts represent true and fair of the financial health of a company, state of affairs, and the results of the period. Making informed investment decision by investors, and then come the investors. Even lenders, as I mentioned, lenders would also look at financial. Nobody is going to give you funds unless your financials are there in detail. In fact, I'll just mention when we come to BRSR that how that is also become important if you need your business to grow per se. Any business, I'm not saying as a chartered accountant. So anatomy of financial statements, you all know, balance sheet, cash flow, and profit and loss. These are the three words you are all well aware. Now, when you come to listed entities, what you have is other comprehensive income. This is an aspect which you all ought to know. There is it's a statement of total income, so as to say. We say statement of profit and loss, but internationally it is referred to as statement of total income. And then you have one component which is referred to as other comprehensive income. And am I right in my approach that these are the terminologies which you may not have dealt with so much? So I'm just referring to it, that other comprehensive income, which we will discuss. And then statement of changes in equity. So far, we have always known as reserves and surplus, reserves and surplus. Now, what you have is equity, which is all reserves and other items also, which we will discuss. So it is statement of changes in equity, which is another statement you ought to have. So you have a balance sheet, you have a P&L, you have a cash flow, and you have a statement of changes in equity. That is what listed entities have. So, and notes to financial statement. Even notes which are there, all ought to be very comprehensive. And many disclosures are there under Ind AS, and more particularly about financial instruments, which also, when one is looking at it, one is certifying it, one will get an idea that how much depth one can get into, and how much narratives, which will give you an idea of what is happening. And when we are on financial statement, one more important thing is accounting estimates. You know, we have many accounting estimates are done when we are finalizing. But in a small organization, generally your estimate is, say, outstanding liability. That is what estimate you would be. At the most, gratuity provision, all these estimate you. But when you go to a listed entities, and of course you, for non-listed also, you will have to look at impairment losses, etc. But when it comes to Ind AS, there is specific manner in which you will have to deal with impairment provision. So that is called ECL, expected credit loss provision. And revenue recognition criteria also, which moves from the concept of risk and rewards to control and performance obligation. See, I will not be dealing with in detail of each of the Ind AS, but just giving you an idea that what are the terminologies which would change. So this is where we are having component of financial statement. And therefore, I think you may not be able to see it so well, but here I have depicted based on Schedule 3. And as you know, Schedule 3 now has 3 divisions. Division 1, of course, in morning you have learned the schedule for non-corporate entities. And when we come to corporate entities, you have Schedule 3 with Division 1, which deals with non-Ind AS companies. Then Division 2, which deals with Ind AS companies. And then you have Division 3, which deals with NBFCs. So these are, Schedule 3 has 3 divisions. And when you are on Ind AS companies or listed entities, you will have to look at Division 2. Am I on the right path? I mean, or you all know about this, so I can skip it. Okay, so now if you can look at this balance sheet, first and foremost thing is that in Division 1, you start with equity share capital and liabilities. Whereas when you come to Ind AS, you start with assets and the liabilities following. So you have non-current asset, property, plant and equipment, capital WIP. Now I've underlined right of use assets. Now this is a concept you don't have in accounting standards. Can anyone explain what is right of use assets? Yeah, so this is a new concept which is there under Ind AS, which is called Ind AS, which is under Ind AS 116, which is leases. Now, therefore, when you have, we have so far learned only a concept of operating lease and finance lease. Now, when you have an operating lease where you, I mean, I will explain in a very common man language that when you have taken an asset on an operating lease for say n number of years, that means you have committed for say 5 years, 7 years, 10 years. So then instead of you taking those expense rental on year, you are taking that asset on your books, okay, as right of use assets and spread the depreciation on that right of use assets and the interest element on a lease liability as your cost or as your expense as against the rental. The rental is a cash outflow. So this is one major change when you are looking at balance sheet. Now, which are the industry which is the most impacted through this? Airline. Airline is the big, all shipping, airline, those who they have, now airline has all their aircrafts on lease. So, you know, all these airline companies or for that matter, retail outlets, companies which are dealing with retail outlets, all of them have everything on lease. And now, which was not sitting, that asset was not sitting on their balance sheet, which is now sitting on their balance sheet. So they were asset light. Now they are no longer an asset light. And airline companies are further impacted for a reason that their lease liabilities are in foreign currencies. So because their lease liabilities are in foreign currency, those also had to be restated. And if those are restated, then the impact have been huge as far as, I mean, airline industry was the only industry who objected for introduction of 116. So when you are looking at any airline industry, this is the aspect you will have to always look at it, that how, what is the impact, how exactly it is working. Then another concept you have here is financial assets and financial liability. Ind AS 109, which is on financial instrument, which deals with financial assets and financial liabilities. So that also have to be disclosed. And there have been definition under Ind AS 109 for financial asset. There is a separate definition for financial liabilities under Ind AS 109. How exactly you have to deal with that, their accounting treatment, etc., also have been spelled out. So you have bifurcation on this disclosure of balance sheet assets, where financial assets also is another item which we need to disclose. Then what you have is your deferred tax assets. Now, as you may know that when you are on Ind AS, deferred tax asset or I mean deferred tax computation by itself is based on balance sheet approach, whereas when you are on accounting standard, it is on P&L approach. And many times because of this balance sheet approach also, deferred tax could have an impact and it may not be the same level as what you were working on AS balance sheet. So any other question on this format? Then you have build trade receivable, unbilled trade receivable. Now, the other day we were just discussing that there may not be any concept called unbilled revenue or unbilled trade receivable. It is only a contract assets. Either you have a trade receivable or you have a concept called contract assets. So when you are looking at financial statements of a listed entity, you have to look at contract assets, how exactly those contract assets are going to be settled, or these the time frame, time bucket for those contract assets.
Like there is cyber security audit is going on,
Mm.
and you have done 50% of the job, 50% in government contracts,
Mm.
then the 50% should show as unbilled revenue,
Yeah,
which is yet to be done.
correct. So, no, this is very recently.
Yeah, 50 lakhs work has been completed, and 50 they have to show as unbilled revenue.
Yeah, that is what the concept of unbilled revenue is. But the other day we were just discussing and it just came out that there cannot be any, of course, I have not done research thereafter, but then we have been told that unbilled revenue also cannot be shown. It has to be reflected as a contract asset. So I have not given my, I mean, this is only 1 year back story. No, unbilled revenue, I'm well aware, unbilled assets as trade receivable or unbilled revenue per se we have been reflecting. However, I mean, the other day we were in one of the seminar where it came out and somebody said that there cannot be anything called unbilled revenue. But we, sorry? No, I appreciate. I mean, I'm with you as far as unbilled revenue is concerned. I'm just saying that I've not done research because the other day we were under one discussion. The answer came out saying that there cannot be a concept called unbilled revenue. It could be referred to only as a contract asset. So I have to independently, we all have to independently examine and see. Otherwise, all bigwigs like Infosys, TCS, everybody is reflecting unbilled revenue.
Sections also.
Yeah, construction, as he mentioned, percentage completion method. Of course, that's a question by itself when you come to Ind AS, whether one can follow percentage completion method or not. So balance sheet, what to focus on? Balance sheet is a snapshot, that's fine. Shareholders' equity and reserves. So understand the structure of the group, whose ownership it is, whose obligations are there, assets, what are the type of, whether preference shares are there, equity is there, convertible preference shares are there, what kind of even share capital is there. And debt and working capital analysis also you ought to be doing. So working capital measures a company's liquidity and short-term financial health. So this, of course, you all are aware. Anybody who is dealing with bank, project finance, etc., are well aware how working capital and all must be dealt with. But when you are dealing with Ind AS entities, maybe the working capital amounts do not change, but you will have to understand each items appropriately to know that where would that fall in computation. If there is a negative working capital, indicate potential liquidity issues. Positive working capital may support ongoing operations, may also indicate excess inventory, excess cash not invested, not taking advantage of low cost debt opportunities. So all these, of course, financial measures which you ought to be looking at it. So when you are focusing on balance sheet, what red flags you have? Declining net worth, if high receivables is there. When we are on balance sheet or any organization, I have one thing which I'm very clear all along, whether it is even in a personal case, you may be profitable, but you are not liquid. And you may be liquid, but you are not profitable. Both are, maybe first one, if you are profitable and not liquid, there is a fair chance that you will be liquid one day. But when you are not, when you are not profitable, then the liquidity could be through borrowings. In the days of credit card, you feel you have a lot of spending, you have a lot of cash to spend, etc. But when you look at the underlying liability of credit card payment, one realizes that you are not profitable because you have not earned that much to spent. So this liquidity and profitability is a key thing which one should always remember. So we go to this statement of changes in equity. So total comprehensive income, it includes total comprehensive income for the period, showing separately the total amounts attributable to owner's parent and non-controlling interest. So those will be those who are outsiders. Then you have effects of retrospective application or retrospective restatement. Now, this concept of restatement, which also you may ought to know, that in case of accounting standard or non-Ind AS entities, you have prior period expense or prior period income. Now, under Ind AS, if there is any prior period income or expense which is material, then you need to restate the financials. Please understand. That means your previous year's figures also ought to be restated. And if it is beyond the comparative periods figure, then you will have to even restate the opening balance sheet. So let us take an example that we are preparing the financial statement for 24-25, and there is a material prior period item for 23-24. Then you will have to restate the profit and loss of 23-24. And that material item is for, let's say, impacting 21-22 or 22-23. Then your opening balance sheet also, as on 1/4/23, you will have to restate. So you will have to give 3 balance sheets. So when you're reading the financial statements, if you find that 3 balance sheet, then you will have to look at it. Okay, what is the reason why this is a restatement done? Was it a huge error, or it was due to it could be restatement due to you have changed your policy retrospectively. That is also possible. So all these will have to be examined, and for auditors also you will have to look at it. If the company is time and again changing the accounting policy, then what is the reason why company is changing? And so as the investor, then you have to give each component of equity a reconciliation between the carrying amount at the beginning and end of the period. Other comprehensive income. So total comprehensive income, then other comprehensive income also you will have to state. Then transaction with owners in their capacity as owners, showing separately contribution and distribution. Distribution means dividend. If you are giving dividends, then that dividend also will have to be given in statement of changes in equity. An item recognized directly in equity, maybe as capital reserve. There could be, when business combination is done, etc., then there could be an item which straight away goes to capital reserve. Then that will also sit in statement of changes in equity. Now this is, I don't know whether you will be able to read it, but I'll read it for you. So this is a statement of changes in equity capital. It has 2 parts. One is equity share capital. So, and as you know, one important thing which of course I have not carried here is the preference share capital. Under Ind AS, preference share capital is your borrowing. Please understand, it is not part of your capital. So preference share capital is your borrowing. And that is one important aspect which you, of course, then there is a convertible preference shares, optionally convertible preference shares. All these there are nuances which one has to deal with independently, but per se preference share capital is a borrowing and not forming part of a share capital. Even under the financial statements, it will have to be reflected as borrowing. So in other equity, if you see, I don't know, can you read it? Because this is just, yeah, so you have this one part as reserves and surplus, and then items of other comprehensive income. So after this slide, we have a discussion on other comprehensive income also. So you have reserves and surplus and items of other comprehensive income. Now, reserves and surplus, like what we have all along learned, is like capital reserve, security premium, retained earnings, other reserves. Okay. And you have to give the movement. What was there? This is 24 balance sheet, I suppose. So you start with movement for both the years 22-23 and 23-24. So movement from 22 to 24 is reflected for each of these components: capital reserve, security premium. And if you see here, I think this is Vedanta's balance sheet. If you see here, there is this one is the reserves and surplus, which is moved out of capital reserve. It was first brought to capital reserve, which was on account of merger. The detailed note is also there to this effect. And then you have items of other comprehensive income. Now, equity instrument through OCI. When we deal with OCI, I'll just briefly explain you what this equity instrument through OCI is there. And then you have hedging reserve. So if you are following hedge accounting, of course, which is hedge accounting, you can follow under accounting standards also because of the guidance note, and foreign currency translation reserve. So foreign currency translation reserve. So all these are coming through OCI. So OCI is though part of total income, but it is not your profit. It is not profit. It is other comprehensive income, which goes and sits in the balance sheet or statement of changes in equity, and then ultimately in the balance sheet. So these are the reserves movement which we just saw. Capital redemption reserve, preference share redemption reserve, amalgamation reserve, general reserve, share-based payment reserve. So this is all types of reserves. So if you look at the balance sheet, as I am saying, look at the balance sheet like Vedanta Limited. This is of Vedanta Limited. I have no interest or no grudge against this company, but I just picked it up. You look at the balance sheet of Reliance Industry. You look at the balance sheet of Larsen & Toubro, Tata Steel, TCS, Infosys. These 10-20 companies and few of the public sector companies also. As I said, award-winning companies, if you look at it, you will be able to understand that what this annual report, an annual report by itself will become one story to tell. Each annual report will become one story to tell. That narrative which we are saying, numbers to narrative, that would happen. So provides a statement of changes in equity, company's equity, which we have dealt with. Share capital, ESOP. ESOP outstanding also will be going in statement of changes in equity. Tracking qualified institutional placement and right issue. So if there is a movement, then who are the investors? Are there new investors? All these also could be looked at. And if there is a dilution for whatever reason, then what would be the impact of dilution? Whether the management interest is reducing, what exactly is happening, that also will have to be looked at. Now, a statement of profit and loss, mainly the revenue recognition. So revenue is recognized only when the control is transferred, irrespective of the invoice date. So the concept of risk and rewards to control. So there could be, and these challenges which you will have, revenue recognition more on real estate industry and even service companies. Number of performance obligations. As I just said, that there is a concept of performance obligation. When revenue recognition is at a point of time or over a time. So real estate industry is one which is getting impacted because of the concept of point of time or over a time. So point of time is your project completion in simple language. and over time is your percentage completion. Now the question is, what real estate industry is doing under Ind AS 115? Whether they are adopting percentage completion method or they are doing the project completion method. Now, as you know, I mean, I'll just take 1 minute to not give a view, but give you a kind of narrative that most of the industry before Ind AS applied resorted to percentage completion. Due to the provisions as you read Ind AS 115, the view came out to be that one ought to be following project completion. Of course, then there was a press note saying that either of, based on the circumstances, either of the method could be adopted. Internationally also, it is being debated these days, but otherwise internationally it was only the project completion which was viewed. What is coming in way as far as percentage completion is there for real estate industry is the RERA provision. I'm just not going into the specific provision of Ind AS 115 para 34, 35, 36, but basically due to that, due to RERA provisions, we are not in position to take up, or real estate industry may not be able in position to take up a percentage completion method. However, there have been counter arguments have been coming. If the agreements are so worded, if the installment payments are so dealt with, a view could be taken to follow a project completion method. And as you know, that real estate industry now, many major companies are listed. And what would listed industry, whether real estate or any company, would want their quarter on quarter to look good. And therefore, they would prefer a percentage completion method of accounting. Be that as it may, I just give you an idea that what happens that. And under revenue recognition, another concept is significant financing component. So it is very important for us to deal with significant financing component, that if any revenue has a significant financing component, then it would not form part of a revenue. It is your interest or finance income.
Exports. The horizon cutoff date, those consignments, undelivered consignments, which are delivered post 31st March. Can we recognize revenue in respect of those undelivered consignments as of 31st March? Number one. And number two, what happens to the insurance rate paid by the exporter prior to 31st March, but remaining undelivered?
No, so I think one will have to look at facts of each case, but one would also have to see the Incoterms of the agreement and then decide whether before 31st March one could recognize the revenue or not recognize the revenue. Whether the shipment has happened, not happened, all these factors will determine whether you had the control over the asset, I mean the goods, or you did not have the control over the goods. So exact fact pattern, we could decide whether the revenue to be recognized or not.
How to ascertain the risk and controls have been transferred or not?
So the underlying agreement of your purchase order or sale order. So you need to compare it with the Incoterms also. there's a concept of Incoterms. Export-import terms like FOB, CIF, all that. So based on that, you will have to evaluate each one of them. At the port destination of the customer, all these will have to be examined and then take a call. So when Ind AS 115 came, this was very much an issue, that what you were recognizing a revenue under AS, whether you could continue to still do the same thing when it came to Ind AS. So you will have to see profit quality. Now, whether it is one time, profitability is higher, then why the one time profitability is higher. This is all what when you do audit also, you look at it. So all these factors, you will have to look at it, but you will have to see. Now, look at this profit and loss. I've just shown an exceptional item. This exceptional item is of 5,000 crores. Okay. Of course, detailed notes are there. There are 2 pages notes of this entire exceptional item is there. But in the previous year, it was exactly reverse. 3,000 crores, 3,700 crores. Sorry, again, it is Vedanta Limited. But so, you get to know so much that what all can a reading of an annual report or a financial statement gives you an idea. And I have just, this is, if I were to give, I would have had to give 5 slides. I've just taken one sample slide to start with their note. Okay. This is their note on exceptional item. And if you see what we have underlined, I will read it for you. Property, plant and equipment. Intangible asset under development, capital WIP, investments and other assets impaired, reverse, written off or written back. So every possible thing had happened in these financials, and then they have listed oil and gas, CWIP write-off, copper, aluminum, then unallocated and gain on redemption of their preference shares, then reversal of previously recorded impairment. So they recorded impairment, they have reversed. Now all that put together, they got an exceptional of 5,000 crores. And similar position was exactly opposite was there in the previous year. Now, this was possible in AS scenario also. Okay, but you will have to look at here because of merger, acquisitions, all those. Yeah, so that is now. But otherwise, this is 24 where whatever events have happened, write-off, impairment, the impact is huge.
It has to happen before demergers.
Right. So other comprehensive income. So we looked at exceptional item. Exceptional item is there in accounting standard also. It is not only an Ind AS phenomenon. It is there under AS also. So had this balance sheet been prepared under AS, maybe the exceptional item could have come, except whatever due to Ind AS could not have come. OCI comprises items of income and expenses that are not recognized in P&L. The component of OCI includes changes in revaluation surplus, remeasurement of defined benefit plan. Now, so revaluation surplus, we used to take it to revaluation reserve. Now it is through OCI, then it goes to the revaluation account. Remeasurement of defined benefit plan. This is another item which goes to other comprehensive income, which is your actuarial gain or loss. See, when you are doing actuarial valuation, apart from other adjustments, you have an adjustment regarding actuarial gain or loss. And that portion of, suppose you have a gratuity provision of 50 lakhs at the beginning of the year, and then actuarial valuation works out to be 70 lakhs. Then you have a component of interest cost, current cost, and actuarial gain or loss. Now that actuarial gain or loss goes and sits in other comprehensive income. And then next is that gain or losses on financial asset measured at fair value through OCI. So then in financial instrument, you have an option to equity investments to take it through OCI or to take it through P&L. Now, when it is taken through P&L, then it goes through other comprehensive income, and it is not part of your profit and loss. And the items of OCI has to be reclassified subsequently to P&L. So when there are these items also have to be bifurcated, whether it is reclassified to P&L or it will not be reclassified to P&L. So you can see this another thing which I have said. This is Schedule 3 requirement also. This is Ind AS 1 requirement as well. So you have items that will not be reclassified to P&L. That is remeasurement, loss of defined benefit plan, tax thereon, and loss on fair value through OCI of equity investment. As I just said, that equity investments can, if it is in subsidiary and joint venture, you can you carry it at cost. If there is an investment, normal equity investment, based on your business model and the decision, you could take it to either a fair value through profit and loss or fair value to other comprehensive income. So here, when you take it to other comprehensive income, quarter on quarter, year on year, you will have to take a hit or gain into your financials through other comprehensive income. Then you have items that will be reclassified to P&L. So gain on cash flow hedge, then cash flow hedge recycle to P&L, and then exchange difference on translation. Whatever the exchange difference is also there, that can go to P&L. So now I'm just, Ind AS is not so scary as it was made out to be those days. You know, if you see any financials, then you don't find many adjustments which call for Ind AS adjustments. And fair value adjustment like equity investments are there, derivatives are there. Then it is as per AS 113 how the fair valuation is to be done. Ind AS 113. The revenue recognition we have just discussed, then classification and ECL model. Now, expected credit loss model is important. Generally, we have learned is a provision for doubtful debts. This ECL is also a kind of provision, but it is based on time value of money and the default rate concept. So this is how ECL model it. So it is a kind of a standard provision which bankers had, this percentage, this percentage. So here also you have to work out a matrix and make a provision, and mainly for trade ECL. But it is a very challenging proposition, ECL model for banks. Of course, today Ind AS is not applicable to banks, but for NBFCs. And I think RBI, if I am right, RBI has even advised bank to deal with this provisioning as well, but I'm not too sure on that. Then lease accounting, right of use assets, which we discussed, business combination. So business combination, today you have under accounts, accounting standard 14, which deals with only merger, amalgamation. But things like demerger, etc., are not, there is no specific standard for demerger. But whereas under Ind AS, you have a business combination standard, Ind AS 103, which deals with all sorts of business combinations. So it will include merger, demerger, and the like.
I think, sir, expected credit loss regarding the banks, RBI has deferred.
So I'm not aware. Somebody will have to correct me because
Not much of it.
Yeah.
It's deferred.
So deferred taxes, broader recognition of DTA and DTL, which we just discussed. So industry example, I discussed real estate, then IT software, unbounding of contracts, impact on revenue of timing, which you just mentioned. Then retail lease capitalization, inflating balance sheet. So balance sheet, now all these asset, like Rajas, if Rajas have a lot of, I mean, which their company, this, they have that entity also, which is in real estate. I mean, sorry, in retail. So all those retail outlets which they take on lease would come and sit on their balance sheet. And then you have a ROU assets and lease liabilities. Banking finance, ECL based provisioning, fair valuation of investments. Investments also have to be fair value. So these are the major impacts. So what I am trying to say is that there are no so many impact. I mean, I'm not exaggerating, but when you really sit down and look at any company conversion into Ind AS, it is not all that big challenges also. Of course, the time is involved, a lot of exercises to be done. Somebody will say that, how do you say that it is so easy? But there are not many challenges. What I'm trying to say is this. And now everything is time tested. Most of the things is time tested. When it had come earlier, there were a lot of challenges, discussion and all that. Now everything is available also. Then cash flow, I think there is nothing much we should be discussing on. Cash flow is operating, investing, financing. So what you have a cash flow under accounting standard, the same cash flow continues to be under Ind AS scenario as well. Yeah, notes to accounts. What lies, this is very important, notes to accounts, and mainly segment reporting, which is there under AS also. So when you look at segment, you will get a proper idea of each of the verticals, how company is operating on. What is the profitability of each of the verticals which it has into. A company like Reliance could be in 20 verticals or any large entities. So when you look at it, how each of the vertical is doing, you may say Reliance is doing extremely well. But if one vertical is not doing well and another vertical is doing well, so you will have to really visualize or understand how which vertical is doing and what are the today's economic scenario, so as to compare where things would move. Contingent liability and commitments, I think it's nothing different than what we have under AS majorly. But all these litigations, etc., you ought to read, because notes is the most narrative part of any financial statements. Thank you. So material accounting policy, let me tell you that under AS, we have significant accounting policy, which has now been shifted to under Ind AS is referred to as material accounting policies and not significant accounting policies. I don't know. I don't think so in AS that change has been there. Now, how does one distinguish between material accounting policies and significant accounting policies? Our experience is we have gone through all the financials which are in public domain, that nothing much has changed when they were showing it as significant accounting policies and material accounting policies. But I could tell you that sometimes we write all the policies, whether presently applicable to company or not applicable to company. So when you come to a material accounting policies, the policies which are not applicable to company, you should not be mentioning it on. Okay, so that's a material difference I can say right now, looking at what has happened under public domain. Okay, so financial instruments. Now, when these notes, this is very important note in the financial statements on financial instrument. Including fair value determination, how fair value is determined, whether it is level 1, there are under Ind AS 113, you have a level 1 fair valuation, level 2 fair valuation, level 3 fair valuation. So whether which level of valuation is done. So based on that, one decides and gives the narratives of that, gives the data for that, figures also of that, that total fair valuation is done. Out of the total fair valuation, what is under level 1, what is under level 2, what is under level 3. And then categories of financial instrument, financial assets, financial level, measured at, as I said, whether it financial asset is measured at an amortized cost. There are concept called amortized cost. Amortized cost is the spreading of that item of financial asset, or whether it is fair value through OCI, or whether it is fair value through P&L, or you have a liabilities which is generally at fair value through P&L or at amortized cost. So you will have to mention that also, and then you will have to give the figures. So it is a detailed figure-wise information is available under the notes to accounts or notes to financial statements. Capital management, how exactly your capital management is there, or to whether you are managing with a treasury operations internationally, domestically, you have a debt, etc. All these also have to be indicated. And financial risk management objective. What are the risk which the company has, and how exactly the company is handling those risks? Market risk, credit risk, liquidity risk, foreign currency risk. If you are dealing usually on export and import, then you are having those risk as well. Emphasis of matter. Now you tell me, of course, these are the standard on auditing, reference to standard on auditing, which I need. But tell me that in your experience, how many of you have given an emphasis of matter paragraph in any of your audit report? I'm talking about unlisted entity.
See one. Going concern.
Yeah, going concern, of course, would always be there. Yeah, so some of you would have dealt with, but this is emphasis of matter is very important. And when do you give this emphasis of, but mind you, emphasis of matter is not a qualification. It is not a modified opinion. So emphasis of matter draws attention to a significant uncertainty, ongoing litigation, which is very significant, say any other development which has happened, or going concern related resolution. If it is given, and if it is uncertainty, now of course it is another paragraph has to be added as uncertainty relating to going concern. But otherwise, emphasis of matter could be there of a going concern resolution. And most of the entities, you know, which has no movement, and we do not comment on going concern. I'm talking about non-Ind AS entities. So that also you all need to take care. True and fair view with legal compliance, reasonable assurance we are giving based on evidence. Now, I'm just highlighted some emphasis of matter. So there is a note which is described, then plans of the company to resume construction development activities of hydropower projects. So company must have stopped that activity, and now they have started, and therefore as at this date comprise of property, plant and equipment of so much, CWIP of so much, etc. It's just a information. It is no qualification, etc. As I mentioned, that draws attention to a significant uncertainty without modifying opinion. So company had this project closed for many years. Now company has started this. So what is to be done? Then you have accounting treatment as per the scheme of arrangement. So if there is a scheme, this is slightly technical, so I'll not go into. There is an ITFG when you are doing an accounting treatment as per the NCLT order, and then even if it is not in terms of applicable accounting standards, you may have to give an emphasis of matter. So, and that is why this JSW Power Trading Company and JSW Green were merged. So NCLT approval, which became effective during the year. So that has been spelled out. Then here, of course, this is for JET. So going concern issue is also spelled out. The appropriate assumption of a going concern is dependent upon the realization of various initiatives undertaken by the company. So emphasis of matter, what are the circumstances which would come out, which you may have to deal with. Key audit matters. Now, tell me on any of unlisted entities, how many of you have given key audit matters? At least few have raised their hand that EOM we have seen, but CAM, of course, you would not have dealt with because it is not mandatory for unlisted entities and it is mandatory for listed entities. So those matters that in auditor's professional judgment were of most significant in audit of the financial statements of the current period, key audit matters are selected from the matters communicated with those charged with governance. So you will have to communicate also. So therefore, in fact, when we give a quarterly presentation, if we on a quarter also, we are of the view that this would form part of a key audit matter, we would intimate to the audit committee also that this will form part of a key audit matter. Okay. And if not, at least in the last quarter, when you are finalize your audit report, you ought to be communicating them.
So these say about non-listed. Simply in case of a bank, this key audit matter would have definitely come when this aging was, those liabilities and assets were not.
Yeah, so I'm not aware about bank audit report, but RBI might have even given them to compulsorily give.
Happened on 31st March 25.
Yeah,
IndusInd
IndusInd
Bank.
Bank, I understand.
It will happen.
So we see.
But otherwise,
Anybody has an idea that banks also give key audit matters? Rajesh? Not your domain. So maybe I'm fully not aware whether they auditors give a key audit matters or not. But anyway, so key audit matters we will.
but in this particular case, perhaps whether the matters were actually communicated with those charged with governance, we do not know.
No, but in that case, I will not. I will hold my comments because it's still not come out. But if there is, I mean, let's not comment because
We don't know.
no, not much. And in a sense that only recently the other external agencies report has come. Last week only it has come. So which is on the lines of what expected loss which was estimated by the company also. Now, what is underlying the audit, we are not aware, so we would not comment on this. Okay, because there could be key audit matter is one aspect of it. But the question of modifying the opinion, not modifying the opinion, etc., will arise. No, that is why I will withhold my comments.
Particularly, auditors are recommending the audit. This kind of a thing must have not come.
Yeah, I mean, I personally want to hold my view on this matter.
So can you give some example of your?
Yeah. I have listed it.
Without giving the name of.
No, name of the company. What I'm giving is what is in public domain. So the slides are there. Generally, it is for, a lot of litigations which are going on, or in kind of revenue recognition. When COVID days were there, how exactly you did your financials?
When you make an export, then it is in the war zone country, something.
Yeah, you could mention. So understand areas of significant management judgment, not substitute for qualification. So that is where I was. Okay. So you can't, one thing one must be very clear, by giving emphasis of matter, I am not absolving if I were to qualify. By giving key audit matter, I am not absolving if the audit report ought to be qualified on any matter. So key audit matters are those matters our professional judgment were of significant in audit. We do not provide a separate opinion on these matters. This is what the first paragraph comes on any key audit matter related reporting. Then this is a litigation. So the company has certain significant ongoing litigation proceedings for various matters with the government of India and other parties. Material matters in relation to oil and gas, disallowance of certain costs under the production sharing contract, claim against the company in respect of gas said to have migrated from neighboring blocks, claims relating to limits of cost recovery. Now all these items are listed. And then
Go ahead.
no, this is of Vedanta.
This is Vedanta, but in case of Go Air also, same thing must have happened. Then they had, the problems with replacement of the engines
Yeah.
made by Pratt and Whitney.
Yeah, Go Air,
Ultimately,
of course, Go Air financials would not be in public domain.
Now, but before that,
So
maybe last year or before that.
there would be many items on emphasis of matter or even key audit matters. And airline industry key audit matters is, MRO provisions, that maintenance provision is really a key audit matter, to ascertain the provision for any in any airline industry, maintenance provision. So then audit, see, this is not a qualification. These are the issues, litigation issues are there. Then how did they, because a lot of judgment is involved. So how auditors approach is also mentioned. And if you see in the next slide, then I think somewhere they must have said also why they are taking as key audit. Sorry. So many times we also list down that this is the item and why we have, because it involves significant judgment, and that is why it has been taken as a key audit matter. So matters relating to trading in shares of Reliance Petro. This is easier to understand also. That appellate tribunal dismissed the company's appeal made in relation to order passed by SEBI under so-and-so section in connection with the trade by the company in stock exchanges in 2007 in the shares of Reliance Petroleum, then subsidiary of the company, against which appeal has been filed with the Supreme Court. Due to completely involved in this litigation, due to complexity involved, management judgment regarding recognition, measurement, and disclosure provision of this legal proceeding is inherently uncertain and might change over time as the outcome of the legal cases are determined. Accordingly, it has been considered as key audit matter.
So this was in picture.
This must be 22 or 23.
Yeah, must be, because later on they paid this component charges to SEBI and matter was settled.
Yeah. So this is, I have just picked up examples only for one to understand and not is what is the status. I have not even bothered to find out what is the status. Okay.
It was settled.
No, fair enough. So my whole idea was to what could come under key audit matter.
Correct.
Now even in one of the audits we signed, where there is SEBI has raised certain issues. So that also we have put it on emphasis of matter because it is before appellate tribunal. So same, almost on these lines. Uh, Fair valuation of investment. Now, this is also very much worth reading. Where when do you specify a key audit matter? This is very interesting. See, as on March 24, the company has investment of 78,000 crores in equity and preference shares of Geo Digital Fiber Private Limited. Okay, which are measured at fair value under Ind AS 109, read with 113. 109 fair value and 113. Now this is level 3. So there is, I have just, I will read the full thing. These investments are level 3 investments as per fair value hierarchy of Ind AS 113, and accordingly determination of fair value is based on a high degree of judgment and input data that is not directly observable in the market. So level 3 is when you do not have the observable market data. Further, the fair value is significantly influenced by the expected pattern of the future benefits of tangible assets. Accordingly, it has been considered as a key audit matter. So, you know, when judgment is involved, a high level of judgment is involved, then it is taken as key audit matter. Now, if you see the auditors tested the design, implementation, etc., reviewed the fair valuation report provided by the management by involved of the internal valuation specialist. So you have very categorically, auditors have categorically said that how these internal valuations are there, and we have reviewed this. Assess the assumption around cash flow forecast, discount rate, expected growth rate, and its effect in business and termination growth rate, and use the valuation methodology, though involved in the internal specialists. See, generally you take fair valuation from external specialists. This has been done at internal specialists. Then they have spelled out that this is how we have approached and considered as a fair valuation, accepted the fair valuation. So it is not a qualification, but it's such an important matter for the auditors also, how auditors has taken that whatever management has given is appropriate, what all procedures they have followed.
Subsidies need to be devalued.
No, you can carry it at cost. It can be carried at cost.
But when we're aware, we where we have invested and that company is not running into loss, we need to mention anywhere, I mean, just to highlight.
No, then impairment is always there. No, if investee company is not doing well at all, then impairment you will have to do. And an associate and joint venture carry at cost, but the provision of impairment standard would apply to it. Okay. So information technology systems and control over financial reporting. So, you know, here also they have spelled out that everything is through IT, and therefore we have considered that also as key audit matter. This is SA 720, which is also important, which I need to point out, because if you know, in our audit report, it is true for non-listed entities also, and then it requires auditor to consider other information which includes non-financial information presented alongside the audited financials. So the crux of our lecture today is this only, that even SS 720 requires you to read everything which is going along with your financial statement. So many times it is recorded, so I would avoid, but many times we sign, I'm not talking about listed entity, but unlisted entities, we sign the financials, and the annual report, etc., will follow later, maybe. But so that could be a challenge where you are supposed to see. And if you feel that it is to come thereafter, then you comment accordingly. So, and other information is financial and non-financial information other than financial statements and auditor's report, which is included either by law, regulation, or custom in a document containing audited financial statement and the auditor's report. So this is nothing but your annual report, and standard itself has said that other information may comprise a report by management or those charged with governance on operations, board report, financial summaries or highlights, planned capital expenditure, financial ratios, selected quarterly data. Now financial ratios are have to be given in financial statements also, right? As per Schedule 3, whether Division 1 or Division 2, you need to give these ratios. So the Division 1 also it requires, right?
Yes.
Yeah. Sorry, at times. So financial ratios are to be given. So which is given under the annual report also. You should see that gross profit shown in your financials is the same as what is shown in your annual report or the board's report. Ensure creditability and consistency of information alongside audited finance helps to identify potential consistency and misstatement in other information. So annual report analysis with and beyond numbers. So this is what is all new in the financial statement. Now we go to board's report. Any questions so far? Okay. So now I think we may have little time, but I'll just rush through this. So this is board's report, as we said, is a report consisting of the prescribed details with financial statement, gives future direction, key risk, whether the board is transparent. Check the language is sign of lack of clarity or evasiveness. You know, in COVID time, it was most important for everybody to read board's report. That what they perceive the repercussion due to pandemic, dividend policy and future plans. Director's responsibility statement. Director is supposed to even make a statement that the accounting standards have been followed and the company is undergoing concern. All these also have to be spelled out by the directors. So MDA, as they call it, which is management's narrative, helps reader to understand not just to what happened, but why. It deals with SWOT analysis about the entity, the company, helps in comprehensive understanding of company's financial condition, performance, and future prospects, going beyond the numbers in the financial statement. This is where, you know, MDA is very comprehensive, where you could see what exactly is the company up to. And all companies, and some companies like pharma, etc., you need to read it where suppose if they are doing some research, where does their research has reached, what stage it has reached. All these also would be available from their management discussion. Their future plans, risk and opportunities in assessing potential impact on future events and trends on company's performance. Yeah, this same thing. Risk management section offers insight into vulnerability to macro changes. Now, the risk parameters which are spelled out here, whether they also match with the notes which you have disclosed, which has been disclosed by the company for the risk management, etc., you will have to coincide. Then corporate governance report, which of course every companies require, and that those reports also have to be certified by auditors. So SEBI LR mandates corporate governance disclosures, ensures key committees, audit committee, nomination, remuneration, risk management, independent directors, their attendance, all that listing will have to be dealt with. Related party transaction. Related party transactions you will have to really look at. In fact, when we are talking about this, for listed entities or NAFRA now has come up with series. They have come up with series where what audit committee should be asking auditors. Okay, because many times auditors are also being questioned, but audit committee has not been questioned or anything. But now there is a communication which audit committee and auditors ought to have, which they have come up with series and what exactly audit committee should be asking to auditors. And they have already come up with 3 series. One is on ECL provisioning, one is on deferred tax computation, and third is recently come on related party transaction. So, even as an audit committee, one will have to ask auditors, have you done this? 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 So auditors on its own also, because that series is in public domain, auditors also should say that this is how they have followed the processes and answer those NAFRA's series which is in public domain. And audit committee have started insisting that, okay, you tell us how you have been doing ECL provisioning. See, it is there, we are doing, but it is not discussed. And audit committee also wants to now or may have to take on their record that this process they have also followed, which NAFRA has insisted or NAFRA has advised them to deal with. And this series is in with discussion with other trade bodies also.
Can we refer to
It's in NAFRA's website also. 3 series have come so far. Related party came only about 10 days ago or a week ago. Now coming to ESG. Now this is a buzzword these days. Okay. So environmental energy emissions, what energy consumption you are doing, what energy saving you are doing, what are the emissions level you have. This could be very important as far as let's say oil and gas industry is concerned or chemical industry is concerned. Then social, CSR, labor practices. It's not only social work. It is even how do you deal with your human resources within the organization. So it is, and the governance, ethics, policy enforcement. This is detailed, there are certain principles which have been laid down. And in the Indian context, SEBI has come up with independent covering all the principles which have been internationally laid down. So we will have, and that is compulsory for 1,000 companies to give BRSR report. So that detail and the auditors can expected to give an assurance function. Auditors or anybody else also can give that assurance function. So ESG reporting mandated through SEBI framework, specifically business report responsibility and sustainability reporting. Institute also has set up many certificate course on BRSR reporting. I think it's not difficult. Everyone should join. At least you will get an idea what is what. Requires 1,000 listed companies. Okay, BRSR aims to provide standardized and comparable ESG disclosures, enhancing transparency and aid investors. See here when, so BRSR reporting divided into environmental protection, human rights, integrity, employee well-being, inclusive growth, sustainable goods and services, responsible consumer engagement, stakeholder responsiveness, responsible public policy engagement. Now here, even a supply chain, you are a company, you are a manufacturing entity, you have a supply chain. Now this supply chain also needs to follow ESG parameters. This will become almost inevitable going forward. So you are, let's say you are in a business, you are on a small scale and you are supplying to, say, very large company, you are supplying to Reliance. and you are not following the ESG parameters, then it is possible that you will not be in their vendor list. So this is very important for all the businessmen, small timers as well, to slowly move towards ESG compliances. And there, you know, the small timers, if we set up our skill, then we could start advising them also that how you will set up in a small organization your ESG parameters. Though from an audit perspective, this may not be directly affect the financials, but the same indicate corporate values and long-term viability. As I said that, you know, your business also would be 3 years down the line dependent upon how ESG compliant you are. Helps in mitigating greenwashing risk. Greenwashing means you give you don't walk the talk. That is greenwashing, the practice of gaining an unfair competitive advantage by making a financial product as environmental friendly when in fact the basic environmental standards have not been met. So you are not doing what you are saying. Owing to these ESG and BRS are requirement, companies now have an obligation to take responsibility rather than deflecting it. Red flags and forensic angle. So sudden spike in other income, related party transaction. See, most of the issues which come up is from related party transactions. And this is what where you will have to, as auditors, all along focus on. Asset revaluation or expense capitalization. You know, frequently you are doing asset revaluation, etc. Those could be the challenges. Frequent auditor changes also could be a question mark for you to decide that what the company is doing. Midterm resignation or citing scope limitations, etc. Restatement of results. You know, if prior year period are time and again restated, then also that means there are governance or accounting governance also is not appropriate, and there could be also a red flag. Analytical tool, I think you must be much better than me also, but you look at return on equity, return on capital employed, debt equity ratio, all these are the things, and hosts of tools are available which will give you information, but you also need to not look at the company's 5 years, 7 years data, but you should be looking at what are the industry norms, where does the company staying on the industry. So, and ROE also has to be worked out, and so many other parameters. This is just, I have listed few of them. I have not listed all at all. But this is how you should be looking at annual report and analyzing. Common size analysis, analyze based on each item of revenue to P&L, total assets. This you should be otherwise also doing as an auditor. As an auditor, you know, when you are doing your ledger scrutiny, but over and above, you should be doing your analytical study. You will have to start saving time through analytical study to comment on. Eye on financials. Now what happened to, so you have to learn from past what happened. In case of Satyam, you could see huge cash, so fixed deposit piling up, and there was no indication that this company is recording fake revenue. What happened to Byju's? Okay, so it's a recent thing. So in case of Byju's also, he went on spending, okay, and he went on acquiring entities, and during first 6 months of pandemic, it did very well. And then all of a sudden, after pandemic, everybody started going to from the virtual mode, physical classes mode started, and he got into difficulties. He defaulted on loans, and therefore then the accounts got delayed. He wanted to do the revenue booking in a different manner, so on and so forth. So all these are the challenges which you see something which is not proper, you need to really look at it. I have about 5-10 minutes. 10 minutes. Okay. So Satyam, then ILFS also, hidden liabilities. This was a fit case for related party transactions, you know. They also see, and it is not that except what you read last week, that 260 crores of that cab fellow.
Yeah.
Blue something.
Blue smart.
So, but otherwise, many times it is not an intention to cheat, but you get into such a position where you then start window dressing, and so window dressing to fraud. DHFL also, window dressing, misrepresented receivables. So general red flags are increasing gross profit margin but decreasing sales, increasing unsold inventory, volatility of cash flow. I mean, you can look at umpteen number of list of items, but you should be skeptical and looking at it thoroughly as an independent.
4 crore audit fees was paid to Satyam's audit. That is also one can think. Why 4 crore rupees audit fees?
No, that I would not comment because the large organization that time, so I would refrain to comment on the audit fees. Anyway, integrated thinking principles and integrated reporting. Now these I will just run through these. This is a new concept which is coming. Integrated thinking principles and integrated reporting, and many companies, we'll see the list, also are giving this integrated reporting. The International Integrated Reporting Council framework defines integrated thinking and lays down its principle. What is integrated thinking? It is the active consideration by an organization of the relationship between its various operating and functional units and the capitals that the organization uses or affects, and integrated decision making and action that consider creation of value for short term, medium and long term. So everything what you do needs to create a value, short term, medium term, long term. So it has to be looked from a global perspective, and we will see this after one slide. Integrated reporting is a process founded on integrated thinking that results in a periodic integrated report by an organization about value creation over time and related communication regarding aspects of value creation, how exactly you have created value. It gives a comprehensive picture of strategy, governance, performance, and prospects. Key elements are value creation and interconnectedness. So how you connect all items within the organizations and connect to the total value creation. Okay. So this is from the council only. So they have defined 6 capitals. Okay. Financial, manufactured, intellectual, human, social and relationship, and natural. These are the 6 capitals one would have to look at. So it is not only the financial capital which one is looking at when we are on integrated reporting. Manufactured, intellectual, human, social and relation, and the principles are purpose. What is the purpose for this integrated reporting? Governance. What governance you have in organization? The culture, strategy, risk and opportunity, and performance. You see the entire images of a global image. You are in an inside peripherals business model. So you have a principles and capital and business models. Your inputs will give you outputs of tangible as well as intangible value. Value creation for the organization and its key stakeholders. You are then leading it to external environment. This is an integrated reporting. And I'll just, of course, enhance transparency, stakeholders engagement. I'll show you which are the companies which is giving Tata Steel, Reliance, Mahindra Mahindra, Wipro, L&T, Godrej, ITC, Hindustan Zinc, Yes Bank. So these are most of the companies have started giving integrated reporting. And I've just taken some slides. I've taken this hypothetical example. If you want, I can get into it, that how exactly one looks at it. We'll take up this one we'll take up. Facing margin pressure for inflation. It's an FMCG company which is facing a margin pressure. Increasing regulatory scrutiny on plastic usage. It is an FMCG company using plastic usage. And evolving shift in consumer preferences toward natural products. So consumer also are shifting to natural products. So what thinking or decision making or action they want to take? Short term cost and volume strategy, re-engineering SKU to offer low unit packs. So their sales unit, they will offer low unit packs to their sales unit in biodegradable sachets, because plastic is a challenge. So they will give it in biodegradable sachets and bundle with slow moving inventory. So whatever slow moving inventory is there, they will incentivize slow moving inventory and give a biodegradable packaging. So this is the decision they will take. So value created maintains revenue and market share during the inflation without deep discounting, reduces stock obsolescence. So old stock is also going away and they are able to create this value. Midterm, responsible packaging and compliance. So they have changed their packaging through R&D. So that also created a value. Similarly, long-term, brand and product portfolio realignment. So that is how they have increased this. This is just an hypothetical example that how does one do this integrated thinking and action. See, this Mahindra Mahindra is given. I will just take these two slides. See how they have done. Input-output model. Financial capital on the top. And then you have a financial capital that what are the output. Input is that financial capital, then output. Similarly, manufacturing capital, then what is the output due to manufacturing capital? Then intellectual capital also, what input is there? Patents granted. These are in quantity terms. So what it gave, these are the inputs of intellectual capital. What it gave? It gave new products launch. It gave new technologies. So this is an output. So this is how one deals with, and the second also, human capital. How many employees you had, and then how many trained employees are there. Then you have complaints. You see there is zero complaint because of this human kind of inputs and what they have done. They have zero complaint. Similarly, natural capital, social, how many women employees they have, number of girls empowered, number of women empowered, number of trees planted, water harvesting done. So this is an overall integrated approach which you have. So investor perspective, I think one or the other way we have dealt with, it is getting repeated. So I can, of course, shareholding also we have said okay, who is holding what need to be done. These are the awards which I was talking about. ICAI awards excellence in financial reporting, recognizing organizations that demonstrate high quality of financial reporting practices. Public sector banks, private sector banks, various other sector banks based on turnover. These are gold, silver, etc. there. Then presented annually. Sustainability reporting awards are also there. So these are the awards, and this is where it matters that your reports are. I mean, you should aim to have this kind of report. Conclusion, blend of audit insight and investor intuition. It is not only you look at from auditor's perspective, look at even have an investor intuition. Reading financial is both an art and a science. Professional must integrate the technical with the intuitive, not just check compliance, but understand intent. Look beyond numbers, stay curious, skeptical, and professionally aware. Skepticism is most important from the auditor's perspective all along. Apply ethics and support transparency and trust in capital markets. So I'll just take only 1 minute now. Of course, this presentation was not that technical, as I said, and I took a lot of help also of other tools available, Copilot, ChatGPT, DeepSeek also, because I didn't want to be technical. And I'll tell you a story. Then I was just working on this ChatGPT. I thought, let me just do some other gimmicks also. So I said, draw a picture of Amitabh Bachchan. Okay. So ask me the question, give me a reference photo of Amitabh Bachchan. I said, I don't have. Then yet it gave me a picture of Amitabh Bachchan. I have not attached here, but it was exactly how Amitabh Bachchan looks like without my giving reference of a photo. But now interesting story. Then I asked, give me a photograph of Paresh Clark. The answer came that Paresh Clark is not all that popular. We will not be able to give its picture. Thank you.
Request everyone, please be seated till the vote of thanks to our eminent speaker. Thank you, Paresh sir, for your outstanding session. Sir, your deep knowledge into the subject was just informative, but truly thought-provoking. May I request our Deputy Convener, CA Lalit Bansal, to give a formal vote of thanks to our speaker. And after that, manager of Kohinoor Hotel wants to say two words with you, please.
Good afternoon. Thank you, Dr. Ji. Thank you, Professor, for insightful and teaching session, which encompasses through numbers to narrative. It was truly out of the box and practical aspect session as to how to understand alerts and EWS from analysis of data and going to which professional, but as an analyst and as an investor also. On study circle, clients we have successful